Mphasis reported an inline revenue quarter, and on most things, including TCV, it was a strong show. EBIT margins were down maybe 10 basis points YOY, but in that range. I don't think there is any fault here. Let's get in a sense of what the telltale signs on the ground are with regards to the quarters ahead, because this was steady as she goes kind of a quarter. Nitin, Rakesh, CEO, and Arvin, Viswanathan, CFO at Mphasis, join me right now on the show. Great having you, gentlemen. Thank you so much for joining in. And Nitin, at the outset, to you and your team, a very happy summer 2082. How do you sum up the quarter? Because it seemed like very strong TCV of deal wins and reasonable execution for the revenues, and the EBIT margins are presumed to be in line.
Thank you for that, Neeraj. I think, again, as you mentioned, right, it's been a pretty steady quarter. We seem to have met pretty much all the metrics that we set out to achieve at the beginning of the quarter. Very happy to report that second consecutive quarter of over $500 million in TCV. I think we've sold more TCV in the last 2 quarters than we did in the last full year. Trailing 12-month TCV wins is about $2 billion plus. So that's a great testimony to the fact that our propositions are working. Clients are actually liking what we are taking to market, ability to originate and close deals, and of course, then converting them to revenue. So I think while there is a lot more to do, pipeline is still pretty heavy, but the environment hasn't changed that much since we spoke last. But our approach of focusing on client by client, deal by deal, account by account business, in a way, what we used to call, focus on the micro in an uncertain macro is what's really yielding a lot of results for us.
Nitin, what happens if the macro were to change, and if indeed there is some trade truce, some bit of business confidence returning? Does this embellish the steadiness that you're depicting in the quarters?
So there are 2 aspects of the macro. I think there are still some businesses that are macro dependent. Interest rate sensitives, our mortgage business. Again, while we've seen growth in that business, it's more on the back of execution of this micro construct. But if the macro were to improve and we were to see volume uptake, that's definitely an upside risk to the outlook that we have at this point in time. Second aspect of the macro really is what you called out, which is trade and geopolitics. I think it's difficult to tell what, when or how, but definitely if the environment gets more conducive, if enterprise confidence in undertaking, larger programs comes in, if we see an uptick in tech spend, which is at this point steady, but not massively growing like it was in 21 or 22, all of that will be good news for the sector.
Okay, but you're not baking that in right now when you kind of keeping your guidance intact. If that were to happen, it might help you up the guidance or give a better number for, let's say, the next year, right?
Yes, absolutely. And I think the reason for that is, one, it's difficult to pinpoint when it will happen, what the extent of it will be, and we don't want to get into a cycle of false starts. I mean, we saw interest rate cut happen last year, but the 10-year went up by 1% after the cut happened. So I think we're being a little bit more prudent and cautious while we're optimistic.
Okay. Arvin, was the EBIT margin flat quarter on quarter, maybe 10 basis points lower YOY? Is it the logistics division performance that is keeping at this, or were there counterbalances and were you happy with the numbers on the EBIT front?
No, I think you're broadly in the range, right, Neeraj? So if you look at, we've been talking about being in the range of 14.75 to 15.75, and we are kind of bang in the middle of that. So in that sense, it is largely where we want to operate. Obviously, there have been a lot of puts and takes. There were some investments we had to make in the logistics vertical, but I think maybe post Q2, you will not really see that. There will be a return to normalcy and return to growth in that vertical. There was a tailwind on Forex, there was a tailwind on utilization, and some of that got reinvested back. But at the end of it, we are kind of flat, and I think we are at the range that we are comfortable operating in at this point of time.
Got it. And what about, the whole, I mean, I'm calling it an issue because we do not know which way the die is coming. Just yesterday or day before, we heard that automatic renewals of maybe the freshers or somebody was canceled, and there were, like, as we know, there are maybe 2,000 news pieces around what is available to you and not available to you guys in the US in the last 2 months. So what's the situation currently? How is it impacting business, Arvin?
Sure. No, I think there is always going to be a little bit of noise, but if you look at it, we have a pretty dynamic supply chain. We react to demand. Gone are the days where you would plan on a supply-led supply chain. Actually, you now look at a demand-led supply chain. So we don't see an issue even with all of the noise. I don't think there is any near-term impact. I think the regulation vis-a-vis what was originally envisaged to now is a much more toned down version. And I don't think we see a challenge. Obviously, we need to be agile in terms of how we deal with people. And I think it is also forcing clients to adopt AI and newer technologies and a global supply chain in that sense. So I think it has a lot of positives for us as an industry, and I think we will leverage on that.
Nitin, I'm rolling two questions into one. I wonder if AI is becoming an integral part of all the offerings and the conversations. But somebody made this note, right, that while revenue for Mphasis has increased about 11.7% compared to September 23rd quarter, September 2023 quarter, the headcount has gone down by 8.9%. So is it, yes, and utilization has picked up, but is it efficiencies? Is it a more of AI now starting to creep in and therefore helping not hire people for the same bang for the buck uptick in revenue? What's happening?
Yeah, I think, Neeraj, you answered part of that question. Some of that leverage definitely is supply chain optimization in terms of utilization. Some of it is also the non-linearity that we've been calling out for the last 12, 18 months. You have the ability to bundle propositions that include not just people-based services, but an element of tech that you can infuse in there. A lot of, I would say, moving parts in that equation. You could even achieve non-linearity by increasing onshore revenue. Not that that's what we're trying to do, but I think it is still early stages for us to say whether how much of that we can attribute to AI going forward. But the direction of travel is very clear, which is the nature of lockstep correlation that we used to see between revenue growth and headcount growth is definitely a thing of the past. We cannot deliver without people. We will definitely still need to hire people, where we need them, what skills we need in which locations, how we embed technology into those solutions is the evolution that we are undertaking right now.
Got it. Nitin, one of the notes that I read, the first cuts, which is constructive on what could be the outlook for Mphasis, considering that there have been some quote-unquote headwinds that you've battled and come out trumps. But the note says that a lot hinges on non-recurrence of client-specific issues and revenue conversion of signed TCV. What would your thoughts be on both of these?
I think both are fair points. I think what they're calling out is certain headwinds in certain segments that we've been reporting for the last 2 or 3 quarters. We called for that bottoming out last quarter. We are calling for that segment to start growing next quarter. So as we stand today, we don't see any such headwinds on the horizon. But businesses being dynamic, we have to just make sure we manage all of that over the next couple of quarters as well. And conversion from TCV to revenue is a very nuanced topic. It is, in our view, a very deal construct-driven approach. In some deals, we saw that in Q1, we were able to convert revenue very quickly. In some deals, we called for it, that it'll take us 3 to 6 months to actually convert them to revenue because of planning, setup, transition, cyber, installing platforms type of thing. So it's nuanced based on the type of deal, what we are committing to the customer, what the ramp-up plan will be, what the duration of the deal is. But broadly, I think that's an execution issue that we'll continue to stay focused on. Nothing to call out for. It's somebody's opinion, and we respect it, and we work around it.